We had Yellen this week say that we could hit X day, or we could exceed the debt ceiling as early as June 1st. What is this doing for markets? What does this mean to your clients?
Sure, right. The X date, that is the point of no return. And that is actually something to definitely pay attention to. No one knows exactly when that X date is, but I do want to put things into perspective. No one, including myself, believes that the US is going to cross or reach that debt ceiling. If you look back to 2011, I think it's important to kind of compare to the last time this happened and see what similarities there were, because I mean, we've had a banking crisis, now the debt ceiling could be breached, or we're talking about that. The market's been pretty complacent in this 4,000 to 4,200 range. Luckily, thankfully, that we haven't seen any kind of catastrophic, sell-off just yet. And I don't know that we will. But I think it's important just to make sure everyone knows that it's a very, very far-fetched idea. However, markets will respond to the drama. And that's one of the 4 phases. There's actually 4 phases here that maybe make sense to go into. So going back to 2011, there were 4 distinct phases to the debt ceiling being breached. First, we had this build-up period, then the drama. Next, we had the aftermath. And then fourth, the recovery into the end of the year. So if we look at that perspective from that lens where we are today, it seems like we're still in that build-up phase. Everyone kind of knows this battle is coming, but we really haven't reached it just yet. We haven't reached that fever pitch of arguing, and the market certainly hasn't reflected that yet. And I think that's important to realize that volatility could pick up and that investors shouldn't be complacent about that. So in 2011, the debt ceiling was first breached in May. And from that point forward, extraordinary measures were taken by the Treasury to issue debt to pay interest so they could pay off all their government obligations. That was reached back in January for us. So we've been on this extraordinary measures train since back in January. So sounds a little bit more dire, to be honest. You mentioned Janet Yellen has already said the X date, the point of no return, the point where extraordinary measures have been exhausted. We don't know exactly when that is, but it looks to be at some point in June. Hopefully it's later in June, but we're saying June 1st right now to even give that probably a little extra wiggle room from Janet Yellen. And really what this all leads up to is the drama, the market volatility. Stocks will drop based off this volatility. Long-dated treasuries, the yields will sink. And we could see a softening dollar too. So commodities might rally on the softer dollar. Think gold, think oil. But once the drama picks up, it's the aftermath that is left collecting all the pieces. And to your point, the debt was downgraded in the aftermath. An agreement was reached in 2011 to avert this type of crisis, but the damage was done. And even though the recovery, going back to Operation Twist, sophisticated, quantitative easing type of tactic the Fed used to keep the curve very level, and quantitative easing itself, these things helped, but the damage was already done. And so that road to the recovery, the losses, although it was a strong finish to the year, the pre-drama market levels were never reached again. So we've got time, not much, and you have to put faith in Congress here that they can get this done.
Stonebriar Wealth Management, advisors for your life.
This is not an offer to buy or sell securities. No investment process is free of risk, and there is no guarantee that the investment process described herein will be profitable. Investors may lose all of their investments. Past performance is not indicative of current or future performance and is not a guarantee.